Good morning, traders. Welcome to the TMT Stock Market Strategy video for Tuesday, August 2nd. Well, interesting developments, I will say. We had a new touch of all-time highs in the ES in the pre-market early dawn session, and we actually rolled over and sold off. So we popped and then we dropped a little bit. Didn't go too far down, but we did move lower. ES ended up being down about 4.5 handles. Spiders down about 40-50 cents. And obviously, it's still crazy that $200 ETF is down 40 cents. So the market's continually being bid up. Today is no different. There is mutual fund inflows. There was a couple of big buy programs that came in, and that's really what the mutual funds do. They'll put out buy programs and just bid up the market, and then they sold off again. So that was interesting. Also, what else is interesting is that bonds sold off. So I want to cover the TLT and I want to cover the 10-year. I think there's a decent trade in that. And more importantly, crude oil continues to sell off. Broke 40 at one point, a psychological level. Now, is that going to affect U.S. equities? And I think it is, and I think it's happening now as we speak. We had a disconnect, a big disconnect, and I'm going to show you a crude oil futures chart. We had that big bearish rise and wedge, and we did finally move lower, but markets kept on going higher. And it's really interesting to see the correlation, and then markets are not correlated with each other. But for the last year and a half, let's say, crude oil, whatever crude oil moved lower or up, markets did the same. And then all of a sudden we have this little disconnect, and it could happen. But I think now, below a certain level of crude oil, you're going to see a lot of pain in a lot of the big cap oil stocks. And then I think that would actually put a little pressure. Now, that could start a little bit of a kickoff of some sort of a pullback. But even aside from crude oil, we do see some deterioration in our indicators. They really haven't, a lot of them didn't do too much. But I want to show you could see this here, the New York Stock Exchange Advanced Decline with Volume, one of my favorites. You could see that we're holding up above the highs here. And it was constructive. Remember I mentioned this before. You've seen this before. Lower lows, lower highs as the market gone up. So we did have that big move up, and it did take out all the prior swings, which is nice, and that's fine. But now it needs to hold back above these areas where it would be bouncing around, looking for higher prices when the markets are up at these elevated levels. It did not do so. What happened? It rolled over, and now we're below zero for the first time. Back in, I believe it was late June, back in here. Okay, now remember, when the indicators start to break below zero and hover below zero like this, you have some issues and you have some cracks in the wall forming internally in the markets. And that's what you guys need to understand is the internal reading, the breadth of the market intraday. If you're trading intraday, you can actually see the markets start to roll over when certain indicators that we use intraday here at TMT they start to falter. Now, sometimes prices just hangs up there and the breadth starts to roll over and then just quickly moves back up again. That's not going to be what I'm talking about. What I'm saying is that when you have intraday market divergence from what breadth is doing, moving lower, and price is stagnant, sitting up higher at these highs, you will get a market that will pull down eventually. Now, the NASDAQ did quite well today, or at least held up about 14 handles, 15 points, not really much of anything. But it wasn't because of tech, it was because of biotech, because biotech is also heavily weighted in the NASDAQ, all right? So you see this is starting to wane here. We have stocks above the 50-day moving average, still at, elevated levels. So everything's pointing to lower prices. Can we move to 2,200 in the ES and the S&P cash? Absolutely. But I do think that the bigger move between August and October will be to the downside. All right, now I want to talk about rates. Here's a 10-year yield, Treasury yield, and as you know, yields rise, bonds go lower, okay? Here's a nice little inverted head and shoulders pattern at the lows, which is dynamite. And we do have a slanted neckline here. 160 is the big key. If we break out at 160, I think TLT will be a great short, and I think the banks will be a great short as well. And it's not because rising yields are great for the banks, but the banks are I believe, are in trouble, and they're not making any money. So even if we get a rising yield, I still think the banks will sell off. And I'm going to put out another video just specifically on the banks, and I'll get a little bit more into detail on that in the coming days, okay? But aside from banks, you could see here, We have inverted head and shoulders pattern. 160 really needs to get take out the swing high, and then I think we get back above the 50-day moving average, and then I think we really chop around. And a big target would be 190 here. Okay. Now let's take a look at TLT. So TLT sold off today a little bit, and here's our proprietary price channels. I've showed this chart to you before. I would like to see this if the TLT could have just taken this out a little bit higher and make some sort of a double top or a lower high from this previous top, this previous swing high, I would be more inclined to look to short that back down to these areas here, 136, 137, and then reevaluate it. But if we take out today's doji, okay, this gravestone doji here, then I think that we'd probably move back down to here, and then we would reevaluate and assess because there's a lot of gaps here. You could see here a lot of gaps. So this is setting up to be a real decent trader here, okay, here. And of course, this needs to be identified as well. So it is setting up to be a real decent trade. I think it needs a little bit more work. I don't think you just jump into it. Why? Don't forget, it is a safe haven trade. Bonds, they park their money. If the market does roll over, bonds will probably pop up where you can get a better price. So I wouldn't chase it here at the moment, okay? Now let's take a look at crude oil. I think this was the culprit. I did a Fibonacci retracement from high to low, and you could see here's the 50-day moving average, and we did have, and I showed this chart to you about a month ago. This is really where our first target would be, and then a second target would be down here. But a psychological break of below 40, excuse me, would probably usher in 37, 35 area, and then I think that would put a lot of scare back into the crude oil markets and also with equities as well. So production started to rise, rig count started to rise, so they're starting to kick back production. And sure enough, as quickly as they put production back online, crude oil starts to tumble. So that's going to be something that we're going to be paying attention to as well. All right, and I just want to show you the ES. A bunch of guys had emailed me, what's the levels here? Real simple, guys. 2150 to 2170 is going to be your level. 13 trading days in a range, which is absolutely insane. But you could see this clearly, 2150, 2170. We broke out intraday early in the morning, and then we failed. So something that I want you guys to pay attention to. Here's the dollar. Now, why the dollar starting to break down? This is interesting because if the dollar really takes out this local swing here at 2466, the UUP ETF, I think you're going to have a beeline rush to fill this gap lower, which is going to do what? Put a nice bid into gold, precious metals, in the commodity sector, right? Grains, if you will. So this is something that we want to pay attention to and monitor. What's crazy about the dollar is that you really can't kill it, if you will. You're not going to knock it down so hard where it's going to just take out lows like a regular stock, because there's so much involved in a dollar. It acts as a huge safe haven trade. So if the markets start to roll over, I would not be looking to short the dollar. I don't even actually play the dollar, only because it's not worth playing. Unless if I'm doing a dollar, I'm trading against the dollar yen or one of the big majors, okay? But just the dollar in itself, no reason to. Look at it as an indicator to help you with your commodity analysis. Okay, let's go right on to the VIX. You could see here we did get a nice little, I should say a little bit, eked out a small little gain. Still heavy complacency out there, guys. This is also a big warning sign because, as you can see, Bollinger Bands are tightening. It's either going to go one way or the other. If we break lower and the next day we come back into the band, buy signal for the VIX, a sell signal for the markets. And I think that this is days away from producing a big buy signal for the VIX, a sell signal for the markets, right? It's inversely correlated, so just keep that in mind. Here's the VIX, the VXX, not on a buy signal yet, but getting very, very close to, okay? Again, sitting at here, you could see how this, you could see the repetitive pattern here, and now we got here coming on. So you can see the small little candles, small candles, small candles, and you're going to get 3, 4, 5 days of explosive moves, and then this could easily get back to $14, $15, okay? But remember, you got to time it right. That's the big picture here, okay? Spiders go into the indexes. You could see here as well, 215.50, 217.50, a $2 range in the spiders for 13 trading days. We've gone nowhere, okay? And this is a good sign that the market did roll over from the intraday highs previously in the morning. So we want to see this start to really go there. And I think it's healthy. This is actually insane with the algos and the HFTs. Just sitting here at these ranges is not healthy. Even you had a huge move up from here. Every day a gap up for 13 trading days. And now you're another 13 days sideways. Not that it's not bullish, but when you come from the lows here this fast, this far, you don't want to be looking to be adding positions here. We're thinking to go to 23, 2400 dollars. Excuse me, 23, 2400 in the ES, or even in the cash for that matter. Not that it can't go, but nothing goes straight up. You need some consolidation. You need a good pullback. So back to the 210 area, 38% retracement still keeps you in a bull market. Even if you came all the way down to the Brexit lows, would still keep you in a bull market. That's how crazy it is. But other powers of B decides that we need to keep the market as elevated as possible for whatever reason. We will soon find out. Spiders 30 minute. Just want to show you guys here. You can see here just crazy 13 trading days in a consolidation. Absolutely nothing going on. Um, Diamonds and the IYT. Bull flag still in the bull flag range. Let's see if we get a pop. If not, if we lose this lower trend line support, we start to head lower. I think it takes the market down with it. You could see that the transports have been very, very weak of late, and now we're below that trend line. If we lose that 50 and a 200, again, like I mentioned in yesterday's video, 136 and 135 will be a test. Okay, and last is the IWM. You could see that 121.60 is going to hold as good resistance, and the lower end of the range is 118.75. Those are your support and resistance areas for the IWM. And lastly is the Qs. We took out the 115.50 is going to act as support, but let's see what happens tomorrow. We're very, very stretched in the Qs. And remember, guys, nothing goes straight up. You look at how far away we are from at least just the 20-day moving average, 113.15. Okay. Hope it helps, guys. Have a great day, and we'll see you tomorrow. Take care.